The single largest factor that determines your overall net worth is actually whether or not you own your own house or if you rent. Homeowners on average have a net worth of roughly $255,000, while renters on the other hand only have a net worth of roughly $6,000 on average. That's almost $250,000 in difference if you own your home versus if you rent. The key to financial success for most people is to be able to own your own house. But how can we make that work? Because down payment and credit score, there's a lot of problems that keep most people from owning their own house. Hi everyone, my name's Ben, and this channel is dedicated to all things personal finance, helping you earn more, spend less, and invest the difference. Now today we're going to be talking about an option that can get most people into owning their own house. You see, back in the 1930s, the FHA, the Federal Housing Authority, they were coming straight out of the Great Depression and everybody's finances were just trash. And the government wanted to get people owning their own house again. They wanted to get the economy back on track. So one of the things they set up was this FHA loan programs that are guaranteed by the Federal Housing Authority. Now, most people that rent houses, usually they do so for one of three primary reasons. And the first is that they just don't think that they're going to be living in that area very long. So it's sort of a temporary thing before they move on to bigger and better things, hopefully. And so they don't want to go through the hassle of buying and selling a house just because they're just going to be there a short time. All right, cool, I got it. Number two, down payment. Banks typically want a 20% down payment using a conventional mortgage in order to give you a loan. So if you're trying to buy a $200,000 house, that means you would have to put up $40,000 just for the down payment. Not a lot of people can afford that much money. And the number three reason people don't usually buy a house is their credit score is jacked up and they just don't think they're going to be approved for a loan. Now, obviously, there's nothing you can do about option number one if you're just going to be living there temporarily, but option 2 and 3, we can take care of all of that stuff simply by using an FHA loan. You see, the requirements for an FHA loan are dramatically lower than the requirements for a conventional mortgage. Remember, this whole thing was set up purely so that people would go out and buy their own homes coming out of the Great Depression. So the requirements for an FHA loan are pretty low. The way this whole process works is that banks typically don't want to lend money to people with a low credit score or low income. They don't have a high down payment or anything like that. Because from the bank's perspective, it's just much more risky for them. The chances of you going into foreclosure are significantly higher. But what the federal government does, the FHA basically steps in and vouches for you and says, you know what? This guy right here, he is going to pay his mortgage, and we guarantee it. Mr. Banker, we guarantee that you are not going to lose any money by issuing this loan. And so the banks, by way of that promise from the federal government, essentially have eliminated all of their risk and are willing to lend to people that otherwise they would not lend to. So the FHA is not the one who is actually creating the loan. They're just simply guaranteeing the loan. They're guaranteeing that you will pay your mortgage. And how much do you need to pay? Well, not a whole lot. The FHA can get you loans for as little as 3.5% down payment as long as your credit score is 580 or higher. Wait, let's unpack that for a minute because there's two really important things here. Traditional mortgages need 20% down payment. That's a ton of money. But an FHA loan only requires 3.5%. So on that same $200,000 house, now we don't need $40,000 for a down payment. Now we just need $7,000 for a down payment. Now don't get me wrong, $7,000 is still a pretty good chunk of change, right? But as far as buying a house goes, $7,000 is relatively reasonable. And the second part of that is you only need a credit score of 580 or higher in order to qualify for this 3.5% down payment option. Now, a 580 credit score is not very good. In fact, that's going to put you in the poor category for your credit score. So don't think that you have to have pristine credit records or anything like that in order to get approved for this program. So what if your credit score isn't 580 or higher? Well, you can actually get approved for an FHA loan with a credit score between 500 to 579. But the catch is, instead of using a 3.5% down payment, Now you have to put up 10% down payment instead if you're within that 500 to 579 credit rating. But like I said, a 10% down payment, that's still half of what lenders typically want. And let's be real, without the FHA loan, no bank in the world would lend you hundreds of thousands of dollars to go buy a house if your credit score was only 500. So this FHA loan is pretty fantastic. Most people with a little bit of effort can qualify under this program. Now some of you guys might be saying, yeah, I've got at least a 580 credit score, but my credit score is jacked up for a couple of reasons, and so because of those reasons, banks still aren't going to touch me. Maybe you've had a foreclosure, maybe you've had bankruptcy, maybe you've got some late payments, whatever the case may be. That's not the end of the world with an FHA loan. Look, if you've declared Chapter 7 bankruptcy, then you only technically have to wait at least 2 years after your bankruptcy is resolved in order to apply for an FHA loan. Now, it's not 100% guaranteed. You would have had to either improve your credit score since you filed for bankruptcy or elected not to open up any new credit accounts since then. But bankruptcy is not the end of the world for these FHA loans, and neither is foreclosures or late payments. Typically with late payments, as long as you have a 12-month record of paying your bills on time, then you're probably going to get approved so long as you meet the overall credit score requirements. The only thing that will immediately stop you in your tracks when it comes to something with your credit score, assuming you meet the overall credit requirements, are things like collection accounts, judgment, or federal debt. So if you have any of those three items, you need to resolve it. Now that doesn't necessarily mean you got to pay all of it, right? So maybe you got something in collections and you can negotiate with that lender. Maybe you had a $1,000 credit card bill and you can negotiate it down to $200 and then they'll just close it off. That's fine, but you have to finalize it one way or the other. You got to close that collections account. Now, since the FHA is guaranteeing that you're going to pay your mortgage, the only way that they can guarantee that you're going to pay your mortgage is they got to have money on hand to basically reimburse the banks if you don't pay your mortgage. And the way that they're going to do that is they're going to charge you an additional fee. They're going to charge you what's known as MIP, Mortgage Insurance Premium. Now, this MIP insurance is not for like if your house burns down or something like that. You're not insuring the house, you're actually insuring the loan. So the way it works is there's actually going to be two different types of MIP involved. You're going to have your upfront mortgage insurance premium, and then you're also going to have your annual mortgage insurance premium. Now, the upfront mortgage insurance premium, upfront MIP, is going to be 1.75% of the total purchase price of your house. But this money can be rolled into the overall loan. So, for example, if you were going to buy a $200,000 house, 1.75% of that would be a $3,500 fee for this upfront MIP. So, if you are buying a $200,000 house and you put the minimum 3.5% down payment, that's a $7,000 down payment, typically that would mean that your loan amount that you're going to apply for with the bank would be $193,000. But you can roll this upfront MIP, this upfront $3,500 cost into that loan. So now your loan with the bank is going to be $196,500 in addition to any other closing costs that you might have rolled into the loan. In addition to this upfront MIP, you're also going to have an annual MIP. And this annual MIP, the fee for that is going to be roughly 1% of the value of the loan annually. So a decent way to kind of calculate what this is going to be is your total mortgage payment for a month is going to be roughly 10 to 15% higher. So hypothetically, if you had gone with a normal loan that did not have any kind of mortgage insurance premiums, then if your loan was for $1,000 a month, like that's your mortgage payment is $1,000 a month, then with this FHA loan with this premium, your mortgage is probably going to be somewhere between $1,100 to $1,150 a month instead. Now, unfortunately, you're going to have to pay this MIP, this insurance premium, for the lifetime of the loan in most cases. And that's why at some point, once you've built up enough equity after a few years of paying down your house, a lot of people tend to refinance out of FHA loans into a conventional loan. That way they can get rid of this MIP. Because if you're putting less than 10% down payment, this MIP is for the lifetime of the loan. If you put at least 10% or more as a down payment, then this MIP is still required for the first 11 years, and then it's potential that you might be able to get this removed from your mortgage. Now, one of the questions that frequently gets asked when it comes to this FHA loan, because it's a relatively low down payment, is how can you come up with the money for this down payment? Well, hopefully you've got 3.5% saved up that you can just do it yourself, but there are a few other options as well. So for example, you can actually get a gift from family members to cover this 3.5% down payment. Now, word of caution, it does have to be an actual gift. So if mom and dad or whoever is going to give you this money so that you can go out and buy a house, this 3.5% down payment, they're typically going to have to write a notarized letter and send it off to the lenders before you get approved for this loan, essentially saying that the money that they're giving you is truly a gift. They do not expect you to ever repay this. They don't want any interest. They don't want any payments. They don't want anything. It is 100% a gift. But beyond getting a gift for this down payment, a lot of different states have individual programs to help first-time home buyers where you might be able to get a grant from the state that could potentially cover the down payment on this FHA loan. Now, every state is different depending on what options they give for first-time home buyers. Sometimes they've got programs specifically targeting different types of people, maybe military, firefighters, police, teachers, that kind of thing. Or it could be just simply based on your income or a variety of different factors. So be sure to Google the particulars of your state to see what kind of programs they offer. So just type into Google the name of your state followed by first-time home buyer down payment assistant programs or something along those lines, and it should come up with a website that details what your particular state offers and what the requirements are for those programs. So look guys, with a credit score of only 580 and a down payment of only 3.5%, you can be a homeowner. And if you're not at those requirements just yet, then chances are with a little bit of effort, you can actually get to where you want to be and purchase the home of your dreams. If you found this video useful, be sure to subscribe, leave a comment for me, give it a thumbs up for the YouTube algorithm, and as always, I'll see you all again next time. Thanks.